Hi, I'm Joe, and in this video, I'm going to cover the basics of inflation. If you're new around here, then my name is Joe. I like to make videos about personal finance, about money, about things you don't really know. And if you want to learn more, then make sure you hit that subscribe button. You hit that bell notification so you know every time I upload. In my last video, I mentioned inflation, and I said that you should make sure you don't fall behind because of it. But what is inflation? So today I'll cover the basics so you can gain a better understanding of how inflation actually works. Bear in mind, I'm not an expert, I'm just an average Joe with an A in A-level economics.
What a joker!
Starting with the economic definition of inflation. Inflation is a measure of how much prices of goods and services have gone up over time. It's basically prices going up over time. Like, why does that happen? That's what inflation is. In 1980, like a cinema ticket was like £2, and a cinema ticket now is like £9. Obviously, depending on where you go to watch your cinema, but on average. But where does inflation actually fit into the UK financial system? How does inflation negatively impact the value of money? Let's start with the former. The money in the system is controlled by a centralized bank. And over here in England, it's the Bank of England, which makes sense. And to put it simply, a committee from the Bank of England get together every 6 weeks or so, around a month, and go over some statistics to determine the consumer's price index, CPI. And this CPI is what is used to measure inflation. So how does it work? They take 180,000 prices of 700 items as a shopping basket. They average the prices of these 700 items. The average prices of these 700 items divided by the average prices of the same 700 items from the month before times 100 will give you your new index. They will have set one month's meeting to be the index and carry on throughout the year using that index. The difference between the CPIs in different months is what is used as inflation. For example, if the CPI from one month is 100 and the next month is 110, then the difference is 10%. Check this regularly to make sure that they are on target for the 2% inflation rate that the government has set the Bank of England. This is the target inflation for the year that the government want the economy to be at. This is so that it can be stable and it can be controlled and it's not going to be bad for the economy. And this rate is usually kept between 1% and 3%, and if it goes above 3% or below 1%, then there has to be some kind of exceptional circumstances. There can be consequences for the economy if it's not kept between that 1 and 3%. If it's below the 1%, then people will just hold on to their money waiting for prices of things to drop, and they just won't spend their money because the prices are too high, so they just won't, and they'll just wait. And that can have a huge negative impact on the economy. That's because when people don't spend money, then businesses fail, and that way people lose jobs. If the inflation rate is too high, businesses' prices are going to go even higher because their costs are higher. And this works in the other direction where people can't actually afford to buy anything and buy essentials because their salaries are not rising as fast as the prices of things are. And so the public won't be able to afford their essentials. That's why inflation needs to be kept between that 1 and 3%. If the inflation rate is too low, there are different ways that government deal with this, but one way you could think about it is they'll start to print more money. This is so that people have more money and will encourage people to spend money. They will also ask a Bank of England to lower their interest rates, or the bank rate. And the Bank of England's interest rate is what determines the other banks' interest rates. So if Bank of England's interest rates go lower, then all the other banks' interest rates go lower. So then it's easier for people to borrow money and spend it. By pumping more cash into the system, the more money people have, the more likely they are to spend. And this is how the value of money decreases over time. The more cash there is in the system, the more things everyone can afford. Therefore, the demand of things are going to go really high. And that rise in demand will mean a rise in costs. And eventually, things go up in price so much that some people can't afford it. And that's why in 1980, a cinema ticket was £2, and now it's £9 because everyone has more money. On the other hand, if inflation is too high, what the government will do to counteract this is they'll raise their interest rates of Bank of England, the bank rate, and this discourages people to spend money or take out loans and spend it because they know their interest rates are going to be much higher. Keeping it between that 1 and 3% keeps it predictable, so everyone, including businesses and the general public like us, we can spend and we can plan our spending without having to worry about massive fluctuations of prices. I unfortunately hear, why don't the government print more money? Too many times for my liking. And well, now you know the reason why they can't just print more money, because inflation will go through the roof. Prices of things that are essential will go through the roof. Everyone will be paying like £20,000 for a piece of bread. This actually happened in Germany just after the First World War, and it was bad, just bad. Like children sitting on stacks of money because it just wasn't worth anything. That is called hyperinflation. So how does inflation affect you as an average person? In day-to-day life, you might not see the effects of inflation because they are very small. And if you take it over a time, only then will you realize the effects and what's actually, changed from like 2010 to like now. For example, 10 years ago, a Freddo chocolate bar was 20p and now it's 75p. If you're a kid, then you know that 20p, it's just a pittance of your lunch money, but now 75p, that's a big amount of your lunch money. So only, maybe the youngins know. And also theoretically, your salaries should be, increasing along with inflation over a large period of time averaged. Theoretically, that's just what should happen. Another way it could affect you is if you have investments and assets, then over time your investments and assets will be worth more because of inflation, and therefore you can sell your assets for a much higher price. So over the last 5 years, the inflation rate has been between that 1% and 3% range that Bank of England tend to stick to, except for when COVID hit, obviously. It was just a bad time for the economy. No businesses were open during lockdown. People didn't spend as much money. Everyone was locked inside. There was no, business activity going on. So people were running out of jobs and it was just really bad. A lot of unemployment, a lot of not spending money. And this meant that the Bank of England's interest rate went down. And this is an example of one of those exceptional circumstances which was justified for the Bank of England as they dipped below their 1% target for inflation. But now it's starting to ramp back up. So back to my original point, in my last video, I mentioned that keeping cash as hard cash in your house over a period of time will be bad because inflation will catch up to you and overtake you. Why is keeping cash bad? Let's say you have £1,000 in 2021 and in 2031, in 10 years time, inflation would have caused a 10% rise. And what that will mean for you is your £1,000 should actually now be worth £1,100. But because you kept it in hard cash, it'd just be £1,000, so you missed out on the 100. So when people talk about beating inflation, that's what they really mean. They're talking about their assets increasing in value over 2%, that 2% target, in a year's time. This way, they're keeping on top of inflation as it rises. Is it this way? Is it this way? Probably this way. I have no idea if that was useful or if that was clear. Please let me know in the comments down below if you have any questions. I will try my best to answer them. If something wasn't clear or if something was wrong, then please also make sure to put that in the comments for other people to see and other people to know the right information. At the end of the day, that's the most important thing. It's just trying to pass on information. So that was my basics of inflation. I don't know if I mentioned everything that you needed to know. If there was something missing, then I apologize. But I tried to cover all the basics and keep it relatively simple. Found some useful information, then make sure you smash that like button. And when you're down there, you might as well hit the subscribe button because it's just painful to do scrolling, 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 notifications. Might just do it all in one. I haven't forgotten about the giveaway. Thank you for watching and I'll see you next time.